Hi, this is Chessie with Chessie Pagano and Associates at Keller Williams Realty. I have here that last update for 2020. Well, here we are, the end of 2020. It's been an interesting year for sure. In spite of all the negativity, the real estate market was red hot. And not just here in Southern California, but throughout the entire nation. And values are up. So besides the low inventory, another factor for the competitive real estate market we've experienced was the exceptionally low interest rates. Today's mortgage rates may still be at a record low, but soon they will rise. This will impact monthly payments and affordability. Many think that the Federal Reserve is in charge of setting mortgage rates, but that's not true. Instead, they set short-term federal fund rates. They are currently at 0. This rate affects auto loans, credit card rates, and small business loans, also known as short-term debts. Long-term debt is the 30-year fixed mortgage. These are tied closer to long-term bonds. By watching any movement in the U.S. 10-year Treasury bond, it will indicate whether mortgage rates will go up or down. Prior to this year, the 10-year Treasury bonds have never been below 1%. As it is today, it's 0.896%. Similarly, prior to this year, mortgage rates have never been below 3%, and today they're sitting at 2.7%. Bad economy news drives the 10-year Treasury bond down, and good economy news pushes it up higher. COVID-19 and the economic recession due to the forced shutdown drove the 10-year Treasury bond below 1% for the first time ever. The United States economy has been on the mend. Retail sales, home sales have rebounded. Consumers are optimistic. Manufacturing has returned. There's a light at the end of the tunnel. The coronavirus vaccine has been approved by the FDA, and positive outlook is on the rise. It will not be long before the 10-year Treasury bond rises above 1%. As a result, expect mortgage rates to increase from today's exceptional 2.7% level to potentially 3.5% by the end of 2021. So let's put this into perspective. On a $750,000 mortgage at today's rate of 2.7%, the payment will be approximately $3,042 per month. At 3.5%, the payment would be approximately $3,368. That's a difference of $324 per month. Or you can look at it this way, $3,912 per year. Although 3.5% is still a great interest rate, the significant impact in a monthly payment could mean the difference between settling for a home that you may not like as much or may not meet all your needs. A 1% interest rate rise in this price range would be equivalent to you paying approximately $75,000 more for the same home. If you have been sitting on the fence about whether it's a good time to buy, don't wait too long. Your buying power could be diminished before you know it. As I mentioned last month, we have the tools to help you win offers over the competition. If you're wanting to relocate, upgrade, or downsize, we can help you sell your home for a much higher value today. As mentioned in previous updates, we can front the cost of updating your home to maximize your return on the investment when selling. You don't have to pay anything until your home sells. Now let's look at the numbers. The active listing inventory dropped by 317 homes in the past 2 weeks. It's down by 9% for a total of 3,152 homes for the entire county of Orange. Even with the active inventory dropping to all-time lows, there are more homes coming on the market right now compared to last year. In November of 2020, there were 15% more homes that came on the market compared to 2019. That's an additional 317 for sale signs. The demand is still high. The number of new pending sales over the prior month decreased from 2,621 to 2,549 in just the past couple of weeks. That's 72 less pending sales, so it's down by 3%. It's the lowest demand since June, but the strongest December since 2011. The luxury market dramatically improved with a sharp drop in the inventory and an increase in demand. In the past 2 weeks, the luxury inventory for homes above $1,250,000 dropped by 117 homes, or 8%, and now totals 1,318 homes. At the same time, luxury demand increased from 466 to 502 pending sales. That's up 36, or 8%. Year over year, luxury demand is up by 223 pending sales, or 80%. And the active luxury listing inventory is down by 377 homes, or 22%. The expected market time last year was 182 days, more than double where it stands today. For homes priced between $1,250,000 and $1,500,000, in the past 2 weeks, the expected market time decreased from 47 to 36 days. Homes priced between $1.5 million and $2 million, the expected market time decreased from 63 to 53 days. Homes priced between $2 million and $4 million, the expected market time decreased from 126 to 119 days. Homes priced above $4 million, the expected market time decreased from 322 to 248 days. At 248 days, a seller would be looking at placing their home into escrow around August of 2021. If you're curious to know what you can sell your home for, we're happy to provide you a free consultation. If you're planning to buy as well, don't forget we can help you trade in your home for a new one without any inconvenience of showing your home ever. We're just a phone call away. Merry Christmas, Happy Hanukkah, Happy Holidays to all. See you in 2021.